Yeah, you can start, Mithun.
Good morning, all. I am gonna be presenting for the seventh time, and each time whenever I present, I learn so much from everybody. In fact, presenting stuff from everyone, knowing, understanding their thesis and the rationale. Uh, I try my max to attend all the sessions live. Yesterday I was live for the whole sessions, and it was fantastic. And knowing the thought process that and what leads to selection of that particular stock and what would be the outcome, that is a different thesis also, as a different thing altogether. So whenever you try to, as in it happens to me, whenever I listen to a particular stock, I see that whatever things a presenter is speaking about, I try to understand the thesis behind that. The outcome can be positive, negative, whatever it is. I've taken the position or not taken the position, but I try to learn as much as you can, and then take your own conclusion and position accordingly. Okay. So that being said, the stock which I'm gonna present belongs to the auto ancillary segment. And the best part, or the unique part about the ALD7 over here is, for all the ALD6 so far, always I've taken the position prior, because I've started learning and discussing that stock later on. But in this case, I'm presenting a stock where I haven't not taken any position. So currently I have a zero position, but here I am presenting a stock, and why I'm presenting the stock and what will lead. Also, I wanted to present why and how I'm going to take the position. So the stock which I'm going to talk about is Divgi Torq, and this is basically an automobiles ancillary segment, or basically it currently deals with the auto ancillary. And most of the times, whatever I have presented is buying pessimism as a thesis, where the stock does not perform at all for last 2 years, 3 years. Nobody looks into it. There's hardly any conversation on Twitter, hardly any YouTube videos made on it, something like that, where there are hardly any players as of now. And once it comes once it get arise as an because of something, and then it starts running, that is when I increase my position. That's how I normally do. So here the company Divgi Torq is basically provides some mechanical machines to the auto companies. I'm going to discuss in future that what are those machines and how are they useful to companies. So this company provides some machines to uh, the OEM companies. Like, it's completely B2B. It's not B2C. There is no possibility of B2C. So B2B business. The clients are like Mahindra, Tata's, and any other company, any other auto companies who wanted certain mechanical parts. Here the market cap is 1,700, 1,800, feasible enough to call it as a small cap, not a micro cap. The book value is 200 rupees. The ROCE is 5.6. RO is 4%. Operating margin is 20%. EBIT 41 crores only. Sales growth for the last 3 years has been negative 2%. Profit growth has been 19%. So overall, the company is bad. And the same way, I start with why the company is bad in general. So here, Divgi Torq's chart. This is Divgi Torq's recent chart. I've taken into only 1 years of consideration. Otherwise, if at all you look into the throughout the period, as in since IPO, it is since, I suppose, 2023 there was an IPO. It went to high as I 1,200 something like that, 1,100 something like that, and then it came around 600, and in the recent, in month of April May, it had a fall till 411 rupees also. This is that 411 rupees. Otherwise, the stock pretty much is in stage analysis. We can call it as a stage one, where it moves upswing, downswing, but pretty much lies around 600 or 580 rupees, something like that. Here we have compared with some of its peers. When I say peers, it is like auto ancillary. The products are not in not common basically between these three companies. So Divgi Torq, the EV by EBITDA is around 30. It has fallen. So it has fallen from 40 to 30. There's a Sona Comstar and there's a JTKT. This is a Japanese company. So this is how it looks, as in, so it's pretty much the valuation wise is around 30 EV by EBITDA. So here are the financials. Uh, the financials of 23-24, financials of 24-25, and the data has been taken from Skinner. And this is the half year for 25-26, basically. So you can see the sales pretty much has decreased over here in last financial year, and as compared to the FY24. The FY25's financials were deteriorated. The operating margin has decreased. It went to 16%, 15%. Also, the profit you can see, which were 14, 14, 13, 12, it was 8, 11, 7. The EPS is also decreased in that way. Now, in this year, the half year, we have a slight profit increase where the profit has increased from 5, then it moved to 9, 11. And this is how it looks like. This is the financials from FY18 to current year. And this is how the sales, which got maxed out at 271 in March 2023. And later on, the sales has been pretty much stagnant or went on the lower side. The same is the case with the operating profit, PT. So basically, the last financial year was pretty much bad, and prior was okay, something like that. The profit has not been grown. That is what was reflected in the first screen. The profit, there has been degrowth in last 3 years. The sales is pretty much also stable or degrowth by 2%. But on the flip side, when we look at the balance sheet side, we can see that the fixed assets has moved from 117 since the IPO to 252. So the assets have increased, as in doubled up. Basically, they have been doing capital work in progress. It's turned out to be fixed assets, and that is how their assets has increased. But the sales is pretty much the same. So in FY23, the balance sheet, the assets was 170. Over here in FY23, the sales were 271. Let's assume the 1 year lag period. So 117 generated 253, 227 assets generated 290, 255, 265, something like that. That is how it is. So in terms of, we can see there's hardly any things which has played with the increase in the fixed assets. And these are the product wise. The product is like, this is the transfer case known as RWB applications. It is 4WD as a 4-wheel drive. We will come across what it is. The manual transmission, then there's dual clutch transmission, EV transmission they are making, and they're making the components which are similar to Sona Comstar's components, but the in terms of the product wise, the most of the products belongs to the ICE. Okay, so this component which started with 73%, now it is around 54, 55%. A torque transfer systems, which is for ICE, ICE as an internal combustion engine, which is like our current old technology, and the EV is the new technology where we are using basically electronical vehicles, and the power is generated from the batteries. And here the power is generated by either gas or maybe petrol or diesel, whatever modes are. So this is used for ICE combustion. Okay, the torque, manual, dual clutch, and this is for battery electric vehicles. And this is the components which is used for everything. So only these two parts are basically are the current or the future scope of new business, and these are the old parts where the hero product is, as in the most sellable product is torque transfer system. And pretty much the company is in mostly most of the business is coming from sunset sector, and the assets have grown, the balance sheet has grown, but the P&L is impacted. But still we are not seeing any good results, as in, because the PL is impacted, we are not able to get any good stock price wise. So I have just created one video. I'm not sure whether you can able to see or not, but let's see.
All right, today we're going to pull back the curtain
Can you hear this video?
on a company that's a
Yes.
huge, but maybe
Okay.
hidden player in the auto world.
This is 7 minutes video. We'll watch it and then we will discuss it further. What further things are being done by Divgi as of now.
Divgi Torq Transfer Systems. We're going to look at one single year that was, well, a roller coaster, a perfect storm that really tested them, but also showed how a company can turn some serious challenges into massive opportunities. So you see a beast like the Mahindra Thar rolling down the road, right? You notice the tough look, the huge tires. But have you ever stopped to think about what's really going on underneath? What's the secret sauce that lets it climb over rocks and power through mud? Well, a huge part of that magic is a super engineered piece of tech called a transfer case. And for a lot of India's biggest vehicles, the company making that magic happen is Divgi Torq Transfer Systems, or Divgi TTS. You could say they're the invisible engine that powers the adventure. And to really get what they've been through recently, this quote from their own managing director just hits the nail on the head. Fiscal year 2025 was a story of two extremes. They were facing some major headwinds, for sure, but they were also scoring some incredible strategic wins at the exact same time. Okay, so let's unpack this tale of two cities, right? How can a year be the absolute worst and the absolute best? It all starts with the company's super deep connections in the Indian auto industry, connections that turned out to be both their biggest risk and their greatest strength. You see, Divgi TTS has spent decades building rock-solid relationships with giants like Mahindra and Tata Motors. They're what's known as a Tier 1 supplier, which basically means their parts are absolutely essential to building the final car. But, being that tightly woven in means that when your biggest customers catch a cold, you start sneezing. And that is exactly what happened. The worst of times part of the story kicked off when some serious problems hit their main business, and you could see the pressure building in the financial numbers. So here's the headline number that tells the first part of the story. Their total income for fiscal year 25 dropped by 12% compared to the year before. Now, for any company, a 12% drop is a pretty tough pill to swallow. But the really interesting part is, where did that drop come from? This chart here really breaks it down and tells a fascinating story. You can see the big problem right away. Their core transfer case business, the heart and soul of the company, took a massive 29% hit. Ouch. But look at this. At the same time, their components business rocketed up by 41%. That contrast is everything. It's the key to understanding their entire year.
So the last diagram which shown, there was a degrowth in the transfer case, while the rest of the two bars were the growth, the 12% and the other percentage. The components grew, the EV transmission grew, but the torque transfer, which is their major hero product, had a decline.
This big blow came from their number one customer. There was a general slowdown in demand for four-wheel drive vehicles from Mahindra, and that meant fewer orders for Divgi's core product. That hit their bread and butter business directly. And then came the second punch, this time from the EV side of things. Divgi makes transmissions for Tata's electric vehicles, but the whole EV market kind of cooled off. People started worrying more about range, subsidies were cut back, and so what was supposed to be a booming growth area just didn't grow as fast as everyone hoped. So with their two biggest pillars, four-wheel drive and EVs, under pressure, what did they do? Did they just sit back and take it? Nope. This is where the story flips to the best of times. Instead of just trying to ride out the storm, Divgi TTS got incredibly strategic and incredibly smart. First up, this was just a brilliant move. They went back to their old contracts, which had these little-known clauses that let them actually renegotiate prices if sales volumes fell too low. By pulling that lever, they protected their profit margins, even while selling less. That's turning a tough situation into a real financial win. Their next play was even bigger. If things were slowing down at home, fine. They decided to go global. They launched this massive push into export markets, locking down new deals all over the place. We're talking the US, Mexico, Korea, Europe, China, Thailand, the whole shebang. And this wasn't just some vague idea. They put a hard number on it. Their goal is to take exports from just 5% of their total income all the way to double digits in a single year. That's not just a side hustle, that's a fundamental shift to make their business stronger and less dependent on any one market. But they didn't just stop at fixing today's problems. They also doubled down on their big bets for where the entire auto industry is heading. This is where they really started laying the groundwork for the future. You see, their whole game plan is built around one critical date, 2027. They see it as a watershed year because that's when brand new, much stricter emission rules kick in for India. Every single car maker is going to be forced to adopt cleaner tech, and Divgi is positioning themselves to be the company they all turn to. And they're tackling this with a two-pronged attack. On one side, they're developing top-of-the-line transmissions for pure electric cars. On the other, they're building something called dedicated hybrid transmissions. These are super complex systems for hybrid cars. So they're not just betting on one version of the future, they're ready for whatever comes next. And this might be their biggest move yet. They signed a major agreement with one of the largest auto parts suppliers in the world to look into making over 200,000 automatic transmissions right here in India. That is a huge deal. It's a play to bring high-tech manufacturing home, and it lines up perfectly with that 2027 deadline. So, after a year with such insane highs and lows, where does that leave Divgi TTS? What's the big takeaway from this whole story of fighting back? You know, this quote just says it all. The company doesn't see itself as just a supplier. They see their technology as part of their customer's identity. What makes a Mahindra a Mahindra? What gives it that go-anywhere soul? According to them, it's Divgi. That deep, deep connection is their ultimate strength. And this is the point right here. While the financials showed at the worst of times, the actual achievements tell the story of the best of times. They became a battle-tested supplier for the Indian Army, won new business from a huge Japanese car maker, built their first ever hybrid prototype, and got named Supplier of the Year. These are the kinds of wins that don't always show up on a spreadsheet right away, but they're what you build a future on. So really what this all shows is a company using its incredible engineering DNA, not just to get through a rough patch, but to completely transform itself. That market pressure became a catalyst. It forced them to get bigger, to innovate faster, and to think more globally than ever before. Look, they've laid out this incredibly ambitious roadmap. They're making big bets on exports, on EVs, on hybrids. All the right pieces seem to be in place. The only question left is, can they execute? Can they really navigate all the twists and turns on the long road ahead?
So this is how our notebook LM presentations ended. And that's the place which I use predominantly to study multiple companies. But I definitely go through the presentation as well as the conf calls also. So just being dependent on Notebook LM, I'm not just being dependent on Notebook LM, I'm just wanted to clarify that. So here we come again. So we got the answer what happened in FY 24-25. We saw that the EV transmission business got slowed down. At the same time, the truck transfers business were impacted because of the general slowdown. And with the recent GST cut, automatically the whole automobile segment of India got regenerated because of the benefits. So the main application which is called as RWD is a four-wheel drive application. The first thing which is important to be noted that this four-wheel drive application is not necessarily be available for all the cars. So this is like an good thing to have. And if it all does not exist, then also we can drive a car basically. But what happens with this thing? So we have the special roads, right? As in the mountainous road where we require more power on the rear side. At the same time, sometimes we require more power on the front side. So this the torque systems, the 4WD systems, basically distributes that power between the front wheel and the rear wheel in a way that it helps the car to move in smoother way. So Mahindra Thar is more like a is useful more for the mountain terrain roads because it has that system which is called 4WD, and that's the reason it is more favorable. So you should not drive a normal car which does not have 4WD in the mountainous road, because if at all it gets stuck, it does not have that system to support to go forward or backward. That being said, then there's a transmission. This is also similar lines. It also helps in the transmission of the powers between the wheels. And then we have the EV transmission. Basically, the EV transmission is nothing but a transmission available for EV battery vehicles. Okay, so these are the basic things we just need to keep in our mind before going through. So the recent car Tata Sierra, which has been launched, does not have 4WD application. That's the reason it is little cheaper, but the other cars which has 4WD will be slightly expensive. The other thing which I wanted to highlight over here, which I forgot, the margins which you see 28%, 29%, all till 20, 23, 28%, it was one of the highest margin in auto ancillary segment. So currently, their margins has fallen. They are coming back to 20%. It went as low as 15%, but now they are coming back to 20% and they will go forward also. The margins are available because the product which they sell in India is one of the top class product, and there are only few products which few companies which produce that kind of torque systems. But this is belongs to the sunset sector. Okay, so the torque systems is so Divgi at one time said that they are, as in they beat the competition by far, and that's the reason they aspire to go globally. The good thing which happened, as in I am a firm believer that in coming future EV will take over every place, as in we won't have ICE engine at all. But with the recent study which I do across US, which is the biggest segment for automobiles, and the European segment, the companies over there are not going EV completely. They are going for mostly for the hybrid system. So the hybrid system basically works on the battery. At the same time, it works with the gasoline thing. So that's the thing. So you can see the Tesla's growth rate has been falling down because it does not survive in the colder segment where it is supposed to perform, it won't perform. And that's the reason people, even though they want eco-friendly, this is stopping the buyers to buy only EV-based car. So sooner or later, wherever we have a colder region, we will likely gonna have hybrid transmission mechanism car rather than only EV. So that being said, if at all it's a hybrid, definitely if at all it's a luxury car, which most of the people aspire to do by today, it will definitely get a this transfer torque. So it will get 4WD for most of the expensive cars. So this is the highlight which I wanted to show for what happened in H1, as in Q2, Q1 and Q2 for FY26. So they talked about the volume expansion in the transfer case. Okay, the EBITDA margin remained about 24%, the PAT margin is 12%. Transfer case, which was degrown, delivered 42% year-on-year revenue growth. So if ICE segment is going to die and everybody is going for ICE segment, so how come they can have 42%? Is the general revival in the Indian segment where we still are buying gas-based cars, if not petrol-based cars, and we are still going for lesser EVs as of now. But I expect the growth rate to getting reduced. But overall, they had a very good half year for this year. Okay, then their transmission side of the e-gear drive business, they are expecting, which was slowed down, they are expecting it to commence much more production because their new key customers are gonna buy. That is what the Japanese customers will be buying. So they had a tie-up with Toyota Kirloskar over here. Why Toyota Kirloskar? Because Toyota Kirloskar is a very small player within the Toyota group. They got in contact with the whole Toyota Japan firm, and then that's the place where they got a big global order. That is what it was shown in the presentation. Then the component business, which is okay, as in there are multiple players, but their components are very specific. With their transmission, they don't make everything under components, only specific which relates to the transmission mechanism or the torque system. Basically, that's their focus is. So this is the second part of the same thing. So they talked about pursuing proof of concept with the Indian OEM for specifically identified vehicle. And they are also talking about selling their talks to not only cars, the three-wheelers also. So they are exploring the side of the three-wheelers as well as on the EV side. They are talking about transmission to the three-wheelers also. So they are going across for their EV transmission. Also, they have started for the new exported product, which will generate 90 crores annually. So this is also a good component. This is part of component. So their component business is also going to drive the business. It's not a small 90 crores annual revenue in the current junction where the whole revenue is around 250 crores. It's a good number. So this being said, so I can think about the next quarters or the next year is going to be better, far better than the current ones. So the long-term growth outlook. So the EV transmission has a capacity to generate 250 crores circa, and then export business will have a 200 crores, which is related to transfer case and the components business. This is only for the battery electrical vehicles component. Then the manual transmission. They're still talking about manual transmission and that hybrid transmission. This has a capacity to generate 1,200 crores. So 1,200, 1,200, oh sorry, 200, 1,400 plus 250, 1,650 crores. They almost have the capacity where they are talking about more than 1,500 crores of business, which they can do with the current assets, because they are not going to talk about more capital work in progress. That's what they are not talking about in their conf calls. But so they are operating at almost like 30% of what they have the capacity for. This is the first presentation during their IPO. I just wanted to highlight the expected growth rate at that time. They still think the top Poplar and the transfer case, which is a part over here, they will still grow around 50 to 57% in FY27 from FY22 to 27. I think this numbers will change. This number will grow slower and the EV transmission will grow faster. And that's their thought processes. The CAGR over here can be huge if at all they can sell their components. But why a company such a small will able to sell this kind of business? The answer lies over here around Q4 FY25. So in addition, we are the one of the three global candidates who have been shortlisted for the larger pool of 15 players. So within the 15 players, for the supply of gear set of this is e-gear set, which is like related to the EV segment for America's leading OEM in the EV space. This potential program involves vehicles that will be distributed across the global markets, and we see significant opportunity not just in EV but also in exports. So this is what they have mentioned in Q4. At the same time, in the next quarter's result, here I wanted to highlight. So broadly, we are expecting 20 to 25% improvement in the volume of EV transmission. Moving forward, our key priority for the EV transmission segment is to enhance capacity utilization by expanding to the newer platforms, most likely to be a hybrid mechanism, which I was talking about. We remain closely aligned with the emerging opportunities across domestic and international markets. Also, here, so on the export side, we are expanding our global reach to engage international OEMs like Ford and Tesla and so Toyota, aligning with the evolving platform. Basically, the one of the three global players they were talking about. So they were one of the three among the three global candidates. Tesla was the leading OEM in this EV segment. They are cross-selling. So currently, they haven't confirmed in the latest conf call also that they got the contract or they did not got the contract. But the point is, as soon as we will get the information, like if at all Tesla has selected this company, then this Divgi as a company for their transmission business, there will be a spike. And at that spike, you will have the knowledge, as in you will know what the company does and what the company is trying to sell forward and what's the capacity utilization, and you can take your own decisions accordingly. So I'm waiting for that momentum over there, or that moment basically, that where I will get certain answers and then I will enter. And that's the reason I said that I haven't taken any position over here, but I'm keeping my I'm keeping my mind open. I've done my studies. So as soon as I get an opportunity and where my thesis works, I will take the position. This is the Q2 FY26. So the export side graphics, basically they are getting into Mexico. Also, one of the programs we got into production approval. Listen to this over here. This it is a ramping up towards the production in calendar 26. So next year, and this is to be a place called Viana in Portugal. It is for an Audi production application eventually. So they already gonna have Audi as an indirect client in coming days. Another part which needs to be noted over here. So, and the Chinese development, basically, they are talking with Korea, Thailand, China, and the Chinese development is rather interesting. It is sort of counterintuitively because people think that China is a place to import from, but since 2001, on and off, we had been consistently exporting to China. So this company has been exporting to China, even though China is the biggest, one of the good auto ancillary segment, and they sell their products to China also. So this talks about their product quality. That's what I infer from. So keeping this everything whole in my mind, I have presented this talk. The thesis behind that, I also have shared the links where I talked about, as in not where I've shared the links of the people talking about the transmission, how does the transmission work, and how does the EV transmission, single speed, multi-speed, and continuous variable transmission, and what is the transfer case is the same as a transmission. So I've just added a snippet also, this transmission and what is a transfer case. So transmission is basically controls the speed and the torque between the gear ratios. And this transfer case splits the power between front and the rear axle. Behind the engine, behind the transmission, all vehicles required, if at all it's an two-wheeler, four-wheeler, or any kind of, only applicable for 4WD or all-wheel drive vehicle. Provides forward gear and reverse gear, provides low range gear for more torque. The key competitor for this particular company in India, for India only, I'm talking about, is Avtech Limited, which used to sell their product to Maruti, but Maruti also started buying from Divgi. So that talks about better product from a particular company. The theme which I said about is buying pessimism, which involves no research done. There's no trade on X, recent no new trades. Stock has not performed in last 2-3 years. This is the theme which I usually play for accumulation. But these are the stocks which I have presented in ALD1, which were based on the same theme. ALD1 Axis Gates, ALD1 Ami Organics, which is known as Acutus, Axis Gates, which was part of ALD3. But along with that, I presented Swan Energy also, which has flopped as which has not worked yet. Tattva Chintan in ALD4, Shivalik Rasayan in ALD6, and Divgi Torq right now in ALD7. Buying pessimism, downside of buying pessimism is buying very early, alone sometimes, doubting yourself every quarter, sometimes losing other good opportunities as capital is locked. So how to avoid that, which I do now, is to avoid downside is buy small early, track every quarter result presentation, investigate technicals, especially good volume jump on weekly basis. That helps me to allocate capital more wisely rather than buying at bulk in the first go. That is what I do now. And Divgi, I have no position yet, but said that I can take position. I may not take position. If you have any doubts, feel free to raise it. I will be happy to solve.
Okay, so that concludes your presentation, right, Mithun?
Yes, yes.
Okay. So yeah, any questions for Mithun? Any specific peers that you think can work with Divgi? Sona BLW, anything on that?
For component side, only Sona BLW, Sona Comstar will sell, but apart from that, from transfer case, there are hardly any companies. And transfer case is the hero product. So transmission side, there are companies, but if they can get Tesla into it, then nothing like it. Also, they have shared some technicals on the presentations also where they talk about NVH, which is noise, vibration, and harshness of a particular product. So whenever there's a transfer case or transmission, basically they try to avoid this NVH as much as low as they can. So the recent product which they have developed also for the hybrid system, they are presented in the presentation that is 30% less in terms of noise, voice, and harshness. So, and that's what they are pitching their clients, that for hybrid, consider us. And they have multiple RFQs. Let's see how it works. But currently, their export segment is generating around 16 percentage, which they wanted to go to 25 percentage, 16 or 11 percentage, which was 5 percentage a year back, 5% to 11 or 16, and then they are trying to get it to 25 percentage. That's it, as in that's what I can think of. But in India, basically, there are hardly for transfer case hardly any company. As in Avtech is gone. Avtech is no more considered as a competition in Divgi.
Yeah, hi
Okay.
Mithun. Ankit this
Hi.
side. Can I ask
Okay.
something? Hello.
Yeah,
Yeah,
yeah, just go ahead.
yeah. My question is, I wanted to know what are the products they are doing in exports. Is it only components or something, or this transmission case as well?
Transmission case, they are trying for transmission case. That's what the Tesla thing is, and the components. Also, the Japanese company, they are talking about buying from here. I don't know whether they will sell directly from, but they so how does components look into generally is they sell at the same price because it's B2B, so they don't get more margin as such, as in very good margins in from a export side of business. So if you think that margins will increase drastically, so that is not the case. So they definitely sell it to their Indian companies or their themselves, and then they export it.
No, no. I just wanted to know their product mix in exports.
Mostly now transmission and components.
Okay, okay. That's
So another question for you from the chat is, any Chinese competitor who can dent Divgi potential in export market?
True, there are players, but there are very few players. But I as in this company is already selling it to China, and
Correct.
very much sure the price at which they are selling it is cheaper than what Chinese companies are doing, because they
Yeah.
from a gross margin point of view, they are still making 63%.
Yep.
So the operating margin was 28, 25. Now it is around 20. It will go back. That's what their ambition is. It will go back to maybe 24, 25. The operating margin 24, 25. When I see in the auto ancillary segment, there's only one company which does good margin is SJS Enterprise, which has a margin of 27%. While the rest of the companies like Uno, Minda Corp, Endurance, Precall, all these companies are in double digits, like 12 to 15% or maybe 17% max. So nobody touches the margins of 20%. So they still have the price, if at all the price erosion happens. Usually the price erosion does not happen in the luxury segment cars, but if at all it happens, then they are last to cut down, as in, because they have that kind of leverage over there.
So what is their exact moat basically? Why they are China is not able to make them? That is the another question from the chat.
No, Chinese are making it, but so it's a mechanical engine. So you have spares and parts, basically you get it joined and run together basically. But the only motors, the precision at which they do and the diamond polishing which they have, they say that this is unique, and that cuts the production. The first of all, they have a lesser cost. Second is the NVH segment, so the noise, vibration, and harshness. This is the main issue of car buyer. So if at all I buy a car, a good car, expensive car, and if at all I start the engine and that kind of noise and vibration, they have the least. That's the reason they are able to sell their products, and that's the reason they are in between the competition among the top three from the 15 from Tesla point of view. So if at all they are being selected, then that's it. As in, so it's a blue sky zone in that way.
Yeah. Okay. Great one. I think we'll stop your presentation here and move to the next presenter in interest of time. But another questions, if anyone has put in the chat, and Mithun, you can take from there to answer
Yeah.
those.
Okay. Thank you. Thank you all.
Wonderful presentation.
And study this company. If you have any doubts, feel free to contact me. I'm available. I usually respond on WhatsApp. It may take time, but definitely I respond. Okay. Thank you. Bye.
Okay, thanks, Mithun. Once again. So we'll move to the next presenter, Somnath. Mithun, you can stop sharing. Yeah.
Should I start?
Yes, yes, Somnath, we can hear you, and you can start.
Yeah, let me know and stop me if something goes wrong.
Sure.
Just a minute. How do I share my whole screen? Entire screen share. Okay. Is it visible, guys?
Yes.
Okay. Let me go to presentation mode. 1 minute. Okay. Where is the pointer?
Pointer options.
Yeah, good morning, everyone. It's very cold here in Bangalore. Just the first slide. I hope you are not seeing this. Are you seeing this? The right side or?
No, we are just seeing the investment disclaimer slide. Nothing else.
But are you seeing the window in the right?
No.
No, right? Okay. Okay. The full screen is visible, right?
Yep.
Okay. Okay. So let me start. This is my first presentation in ALD. So this is just a disclaimer slide. I'm trying to scroll. Yeah. So I'll be presenting on Epack prefab today, but mostly just brief introduction about me so that you understand my thesis or align to my investment philosophy. I am a working professional in IT services, having 20 years experience. I have been actively investing from last 5 years. I have been learning fundamental analysis from Ishmohit SYC and technical analysis from Puneet. I have been incorporating both the analysis in my investment philosophy. And I am a GARP type of investor, grow at reasonable price, where I mostly will look into growth stocks or growth businesses. And I'm very shameless at cutting position whenever something doesn't play out or market gives me signal that something is wrong. So just telling about myself so that it's easy to align and see how I see the business. Yeah. So going to the first slide, this is a sector overview. Mostly, many will be aware of the PV segment, right? So PV is pre-engineered building. These are the new type of building that you will be seeing in this Blinkit, Zepto, and many other structures where they bring in steels and they simply build the system very fast, rather than the traditional ones, which will take time to build. You need cement, you need bricks, you plant the iron rods, and there are many other things, right? So you are aware of. So if we go through the sectoral overview, we'll go slowly here. So our construction and infrastructure, right, that is growing everywhere. You see that there is government policy shift. We are trying to go to the green mode, and there are multiple buildings that are getting erected for different sectors. And PEB is slowly catching up in India. So if you see the penetration, right, we need to understand how much growth has been and how much the TAM is. So the penetration in India is 3 to 5%. And these are like the sources of these numbers are from all the PB sector companies that are currently investable in our market. There is Interac, there is EPAP Prefab, then there is MBL, then there is Pennar. So if you go through their DRHP, you will get these numbers and they do match. So these numbers you don't have to take with pinch of salt. These numbers are standard, and I have cross-checked in multiple DHRP. So if you see here, right, so 3 to 5% only penetration is in India. So that means rest are following the traditional method. So how does the number show up in other countries? If you see in US, right, I think there is 80% penetration, and Australia 50%. Europe, there is almost 30% penetration. And in PEB, right, you will see that iron usage is too much, not iron, exactly steel. And right, China imports iron and makes steel and they use it. So now right, the growth that they are getting, why they take so much steel to make factories and all. So you can join the dots there. So underpenetrated sector, so there is a long time to grow. This is one important thesis. Another is how are the companies that are there in our market growing? So they are growing at a rate of, the sector is going at a rate of 8-9%, but the investable companies, right, the private companies, they're growing at 2.5 to 3x. So even if you see here the lowest band, 8%, what happens is the growth is 24% for these companies like Interact or others. Now let's move to traditional versus PV, how they are beneficial. So 40 to 50% less time than RCC construction. So time is a factor when you set up industries, when you do capex, right? So that's one point where it takes almost half the time to build these systems. You don't need to feed water from time to time. There are many other things that are there, like these steels are already, they come from factory and they just join them. That is what they do. Not much of manual labor is required. So manpower also is required 25% less. So that means not only you save on manpower, but also the time is taken less. Mostly industrial and warehousing, you cannot do it in multiple things, like you cannot do it in hospital unless you are doing it in rural area. Then you cannot do it in hotel sector. These things, I think they're planning to move in those sectors as well, but as of now we only see in industrial and warehousing sectors. Flexibility in modification, so right, what happens from time to time is these companies, they bring in new, something happened. Yeah, okay. Okay, so what happens from time to time is you will see that these companies, they bring in new machineries. The machinery sizes may vary. So initially may be small, they may become big. So if you want to modify the warehouse that you were hosting these machineries, then you have to break the building, expand the building, break some walls and all. For PEB sector, it's very easy. You can simply dismantle. In fact, you can dismantle the whole PEB building and make the with the same material to a nearby site. So that flexibility is there, which is not there in traditional ones. Then horizontal versus vertical. So now you'll see that land acquisition for companies are very, very easy. You'll see some government like in Andhra Pradesh, and you'll see in newspaper cuttings that the land has been given to so and so company for rupees 1. So land is not a problem. So it is easy for movement of goods as well as machinery deployment in a horizontal building rather than a vertical one. So horizontal PEB is more efficient than vertical. Though there is a news recently that Epack prefab is making a 13-story building for their own employees, I think. So vertical is also not out of the picture, but horizontal is what we see mostly in PEB sector. Then coming to lower cost for PEB, yes, the cost is less. I have got different numbers, how much cost is less, but it ranges from 20 to 40%. I did not want to include a specific percentage because I got various different data points from different places. And it's green. So what do you mean by green? Let's talk about that. So you know, in Delhi and Noida side, construction work is stopped during winter and some months in a year. The reason being, the cement, the dust, they flow around, and those are halted by government. So you have restriction that you can't build or construct some building during those times. For PEB sector, it is green, means there is no dust, there is nothing. You just make the steel pipes and material in the factory. You move to the place where you want to deploy, then deploy them, and then connect them. So this is the green part. These are the industry metrics, but these vary quite a lot. So EBITDA is 8 to 10%, but some get a little bit higher percentage here. Asset turn, though the average asset turn is 3 to 3.5%, but we have seen a lot of companies doing better. Like Interact does, I think, 5.5. EPAC prefab does 4.5 to 4.7%, 7x. So there is a quite variance in this. Don't go by this number. This is average industry rate. And last one is the ROS. So ROC, we have seen in good companies, they do from 18 to 23, and some are less, but we'll see those in coming slides. So this is the main thing. So I wanted to paint a good picture that these companies, though there are so many listed companies, they are like small fishes in the big tank. But do the small fish remain small, or do they grow? That is more important for us. So we have to track the growth numbers. We have to see if they can grow and they can utilize this under penetration of 3 to 5%. Hope this was clear, because this is an important slide and this is an essential slide for the PV sector as a whole.
Yeah, it's good.
Okay. So let's talk about Epack prefab. Basic company overview I'll give, and then we'll do comparative analysis and other things. Just let me hide this. So Epack prefab, right? Why this special name? So Epack. So previously this company used to make e-packaging material. That is the you must have seen, right, when your TV comes or refrigerator comes, it comes in some thermocol and all. So that thing they used to make, that they still have the factory, I think near Noida. It is just adjacent beside the LG factory, and still that was their like bread and butter initially. So they don't want to part with it. So when asked to the company executives whether do you want to go away with this part of the company, they told no, it is, we have historic tie up with this, so we don't want to get out. But as it is growing at 6 to 8%, we'll be continuing with it, but our prefab business will be growing, so that will be like significantly lower percentage as a whole. And prefab, why do you call this? This is prefabrication. So what happens is the whole body structures of the warehouse and all are made in factory. Only we bring those structures and we join them. So that's why we call prefabricated structures, those structures as a whole. So that's why this name came. Just going by this, it is a leading player. The top three players are Kirby, Interact, and Epack Prefab. So it is the third player, you can say. And they are strategically positioned to benefit from this growth and all. This is fine. This is a very old company, 25-year-old, but they have been doing this PV sector business from 8-9 years. That is what I found. Okay, let's go to the next point. Key verticals, they have two business. Prefab is the core focus business. This, they are not growing. They are almost getting 50% from this packaging business is getting 50% orders from the LG plant, which is beside it. And they just want to continue with it. The growth rate for this polystyrene business is 6 to 8%. So it is not degrowing or anything. So it won't affect the overall growth perspective. Market leader ranks as one of the top three. Kirby and Interact is there. Already told. Sector serves mostly everywhere you see recently, right? Everywhere this PV sector is growing, and it is used in all the sectors, all all these solar module companies, then the warehouses for quick commerce and everywhere. In fact, in metro and all, everywhere it is used. High growth performance. So they have, we'll talk about the growth in the next slides and we'll compare also, but mostly they have grown at a CAGR of 46%, which is highest in the all the peers. Business mix shift. So initially, if you see year on year, you will see that initially the prefab business was 72% in FY23. It has grown to almost 85% now in 25. So currently, I think 85 and 15 is the ratio. Operational efficiency, they have been expanding EBITDA margin. I'll talk about the guidance, how much they have given and what is the exact EBITDA margin that they're going. Their result was very good in H1 FY26. Maybe we'll see. Strong revenue visibility. Mostly they have a good order book. 916-17 crores was during the result time. Now this has grown to almost 1190 crores. So every now and then you'll see that they are getting orders. Investment thesis and future outlook. What is the main thesis? Main thesis is they are expanding. They are doing capex. I'll talk about that. And their extraordinary growth that they have shown in past 5 years, and also what they have been showing in the last result. So it is a new IPO. They had only chance to give one result. We'll see that the continuation of growth is seen. So this is a brief introduction about the company. Now we'll go to the next slide. Some fundamental numbers, ratios. So P is 37. We'll compare. In screener, you'll see some 41, 42, but do your own calculation. I think you will get around 37. ROCE is highest, 23.7%, and they say that they will maintain from 21 to 23. Market cap currently, this is on Friday. I think it is 3236, very small. Debt to equity. So debt, they have negligible debt. Don't go by these numbers that you see in screener. They had 210 crore loan of 8.85%, which is good interest rate. What they did is from IPO money, they have paid, I think, 70 crore of 210 crore debt, and they have a FD of 145 crore. So you will ask the question, why do they keep this debt then? Because they need some money from time to time for the capex, and they want to do through internal accruals. So that's why they keep some money in FD. Stock price currently, it was ranging from 300 to 310, and currently it is 322. This is, I think, Friday. Now these are important slides, and I want you to take something out of it. So these are comparative analysis of each of the players. We will be mostly focusing on Epack, Interact, MNB, and Penna. These are listed. Kirby is the largest, but their growth numbers are not so good. I don't want to compare also, not listed player. These four, you can ask me any questions because I have been studying all this. I think Interact, someone has already given a session, very nice session in ALD itself. So if you see here, right, here, so Interact is the market leader in the listed space. So if you see here, right, here how much is the sales? 4,522. How much is Interact sales? 8,300. Now, currently, if you see, right, the growth, almost Epack is catching up very fast. So growth number is exemplary for Epack, but we need to track and see whether this growth number sustains or not. Again, this growth number 41.79 is for the prefab business. It is not for the overall business. If you see the overall business, it should come around 36%, but still it is good number. Sales is very important. Profit, you can show good profit by cutting down many expenses and all, but sales is where it shows that this company is able to sell at a higher rate. This is operating profit before depreciation, interest, and taxes. You can see the growth. Epack is decent. Interact is very good. You may dig deep into why the sales percentage here is high, and how can Interact beat it. This is a good question. So we need to check. Moving to key financial ratios, mostly I am more interested in seeing the ROE, ROC rather than the other numbers. So if you see, right, consistently it is 23, 24%, which is good. And for others, if you compare MNB and others, it is good for MNB. But if you see with Interact, again, so ranging between 18 to 23 is what we have seen for ROC. It should be, so currently our GDP is 8%, our inflation is 7%. So anything above 15% it should be. So if we are growing better than that, it is very good. Okay. Here I forgot to compare the MNB and PENAR. So these are not good numbers. I don't feel it. PENAR has a 50% mix of different verticals also. MNB is pure 100%. That also we'll see how much pure factor they have. Yeah, here it is. So if you see, right, EPAC has 75-15% almost pure play. Here we'll not talk about Everest Industries. We'll talk about Interact. It is 100% almost prefab business. Kirby has 100%. MNB has 77-23, but 23 Proflex also is used in prefab. So you can think of it as pure play only. Pennar has 52 and 48. So this is not pure play. Pennar has been telling that they will be increasing the margins from so many quarters. They have been doing it, but not very good. And they have issues with labor. That was highlighted twice, I think, in last two call. MNB, they were showing margins very good after the listing, but in the first con call, many people have asked whether this margin can sustain. They told yes. Later on in current quarter, we saw that the margin has fallen. Okay. Now I have done a comparative sheet between EPAC, Prefab and Interact. The reason being, many will be invested in Interact. And why do we need two companies when we can have one company in our portfolio from a sector? So this is a basic comparison. So if you compare on most of the factors, we can see that growth of prefab business is 46.2. This is 20%. So here EPAC wins. Order book, current order is 1190. They have an order better than EPAC. So Interact wins. Similarly, on other fronts, EBITDA margin, EPAC has told that they will consistently give 10.5 to 11.5. Interact has been telling that they will try to increase margin, at least in this quarter. Previously, they were telling that they can't grow much margin. But this quarter, while comparing with peers, they told that we'll try to better the margins. But here also, EPAC wins. ROE is better for EPAC. Working capital days, if you see the numbers on screen or other places, you'll see very less. But when talked with the management, they told that it will be going to 35 days. Currently, I think 17-18 days is there, but it will be going to 35 days. As they're getting more orders, this is slightly increase. Here also EPAC wins. Debt to EBITDA, I told about the debt, right? So this is almost negligible debt. They will be, for the recent capex, when they were asked, they told that they will be doing from internal accruals only. They won't take much debt. But even if they take it on a very reasonable interest rate, which is 8 point something, which is good enough, I feel. They are not taking any high risk like 15-18% interest cost. P ratio is high for EPAC. Looking at the reasons we have seen, their growth numbers are very good, so they may command a higher valuation than Interact. Pure play, it is 85%. For Interact, it is 98, or you can think of it as 100%. So it is more, Interact is more pure play than EPAC. Last one, how much capex post IPO they are doing? 170K they are doing. This is brownfield. This is not greenfield. There is another greenfield lined up. Interact, I think they are doing 65K initially plus 25K. This should show up in Q3, Q4. So mostly, if you compare, right, you see that Interact has come more number of times. So should we just make Interact as winner? Not so. It depends upon what you are looking at. So for me, I initially told that I am a GARP investor. I like growth. So I am looking into this. I am looking into, where is the ROC? Yeah, this one. So these are important for me, and also margin is important for me. So these are like clear favorites for me, and I would focus on this. Everyone is getting order and doing capex. All the four listed companies. So they will keep on getting order as of now, and they will be doing capex and increasing. But these numbers matter. Interact has done very complicated projects, and they're very good at doing complicated project, whereas EPAC has done very fast project deliveries. Like execution is superb for them. So these two differentiates. Both are good companies, but take a call based on what type of investor you are. So yeah, some interesting info from the con call. So here, if you see current capital, sorry, where is my mouse? Current capacity utilization is 80 to 90%. So there was a question from Concall that you are already at 80-90%, sitting at 80-90% capacity utilization. Then how will you grow in Q3 and Q4? So Q4 there is a brownfield capex coming, and in Q3 they told that they have done some debottlenecking already, so they will get good number. H2 is heavy. This is not only for EPAC, but it is same for all companies. So 45% is H1, 55% in H2 mostly. This ranges from 45 to 47. This also ranges slightly, but H2 heavy for all Interac, MBL, Penna, everyone. This is mostly due to rains, so that's why the first half is little bit less. Visibility of revenue at 906, this is 916 crore order book was there during the result time. Now it has grown, so they had 8 months visibility. This type of business has similar visibility for all the companies, so they keep on getting order, they keep on delivering. And if you have like 6 months to 12 months of visibility of order, that is good. Brownfield capex, they are doing a brownfield capex at Mambattu, Andhra Pradesh. This will be starting at Q4 FY26. Greenfield capex, they have one lined up at Q2 FY27. This is in Gilot, Rajasthan. Current market share, yeah. So this statement was told in con call, but I have heard from multiple players same story. So how much you have to believe? Everyone is trying to go. So they are telling that their current market share is 5% and they want to go to 10%. I think in MBL also they told, and many other company con call they told. So yeah, they are trying to grow. That is what we have to take it. Margin should range between 10.5 to 11.5. So this is good. So there is a stability of margins, and we hopefully it doesn't go below 10%. So this is one aspect I'll be keeping on tracking every result. Overall asset turn is 4.5. So you saw the industry, right? Initially we saw 3.5 around asset turn, but these companies, the listed companies, they do much better. These are like average of the panels, the steel materials they do. 4.5 to 4.7 is what EPAC prefab does. Interact does it better, I think 5.5 almost. Did I forget something? No. Steel price risk. So they told that it is hedged. They build inventory buffer of 1.5 months before starting. So this is hedged already. But 1.5, is it sufficient or not? That you have to think. Packaging business growth is 6 to 7%. So that is a business we won't want to invest, but it is stuck with prefab. We can't help much. That was a legacy business, but at least it is growing. It is not degrowing or anything, so it won't impact the overall growth. ROE ROC is very good. I feel one of the best in the sector. I think MBL also does, but I have to check the recent one how they did, because their margins also fell. Finance cost, okay. They told that the finance cost will be largely offset by the FD interest. They have a FD, and that interest, whatever they get, that will be sufficient for them to give the interest for the loan. So they already paid 70 crores of debt. So deleveraging will add 0.3% margin going forward. That is what they said. So these are some important points that I could gather from the con call. I would request you guys, if you are interested in this sector, because it is a growing sector and it is having tailwind. So go through all the con calls and don't just rely on notes. Go through them in audio format. You will know how much what the tone of the management is, how much they are planning to grow, and how bullish they are. Yeah, so coming to technicals, so this is just newly listed entity, right? So not much data is there. Just so technically it is strong. Here the earning was there, and it shortly rose up after that because the result was fantastic. And after that, now it is like consolidating between these two ranges. So not much from technical perspective, but we have to keep tracking. The whole sector is in tailwind and doing good even in this choppy market. This is just a valuation for comparison. Some like to do it on EV EBITDA. Some like to do based on P. I personally like P for this PB sector. It is overvalued. It is overvalued for a reason. And I feel that this whole sector can re-rate, like in cables, right? Wiring and cables. So what happened to polycabs, like a polycab and others? This whole sector can re-rate if the visibility of growth lasts for 1 or 2 more years. This whole thing can re-rate to 50p. That is what I have seen. Whenever one sector shows continuous growth for certain period of time, the sector gets re-rated. So there is a chance. It is not super high for any of the players, and there is a chance of re-rating if they show continuous growth for all the players. This is a rough estimate that I have made. Normally, I do not look past 6 months, 1 year, but I have just made so that it is easier for you to have an estimate. Uh, Sales, I am gauging from management commentary and their results that they will do 1600 crores of sales this year. And this is with 30% growth. Management had told that they will do 30 to 35% growth year on year. And this is on 35% growth for next year, and looks like they can cross 2100 crores. These are just estimates, and from there you can see the PAT, and you can also calculate how much the forward PE may be. And if you give an exit PE of 25 or 30 or 35, right, there is a good CAGR to be made here. This is rough estimate. Take it not with a pinch of salt, with a handful of salt, but better is you keep on tracking these numbers, and if they are in line, I feel they can even exceed 1600 crore, but let's take 1600 crore this year and see whether they can achieve or not. Some antithesis pointers. So there have been some in all the four listed players, right? MBL, Pennar, Interact. Interact has been consistently underguiding sometimes and doing superbly in their results. Pennar and MBL, I have seen Pennar and MBL have their what do you call in US also they have two factories, so they get some benefits of that. So they should be doing better, but they are not. Um, why do you need factories in different places? The reason being, you cannot export. You cannot make in India, then export the steel. Those are heavy things. So if you want to export, you have to build your factories in other countries. So currently, EPAC prefab they are doing in Nepal, Bangladesh, and neighboring countries, but they are not doing outside that, and they are not trying to explore also. They told that India has sufficient market to be captured before going. Pennar has it, but Pennar and MBL has in US, but the growth numbers that I see, they can make good margins there, but not sure how they're doing. So let's go through these antithesis pointers one by one. So high capacity utilization is there, and debottlenecking will rescue us in Q3. But what happens in Q4, we have to see. So are they going to do good and all? Limited export optionality is a antithesis for EPAC prefab. Steel price volatility, they told that they have inventory of 1.5 years. What happens if there is more volatility and 1.5 months are over? Past history, we know it has been good. We have checked it, but we have to check if management walks the talk. We have seen that Pennar has been telling that will increase the margin, this, that, but they have been giving excuse like labor excuse and all. So we have to track this EPAC free we have also. MBL also told that our margins won't erode, but if you see current result, the margins have eroded. Packaging business is a drag for the overall business, but we have to track it. Also, India's growth, if it suddenly slows down, there will be impact on this whole sector. So that has to be tracked. These are some antithesis pointer that I came up with. Let's go about moat management and clients. So there is no moat in this business. Anyone can enter. But yeah, you have to show execution. So execution is moat here mostly. And execution wise, I think many of the players have done good. They have a very good ICRA rating, which is very stable, A plus, the best in the market. Managements are all experienced, not from IIT and all, but very experienced management and doing good from 25 years. I did some background checks. There is no red flag that I could find. If you guys find something, let me know. I'll be interested. Repeat client is 43%. For Interact, it is 80% or more. I feel repeat client is not important. In fact, repeat client may give you less negotiation power and your margins may get dragged. That is one reason I find Interact has a low EBIT margin, but I may be wrong. So just I am guessing. So repeat client, you don't. It is not that it is good or bad. This is not a variable that I want to track. Some news post results. So you saw, right? The order flow number was different, but they got some new orders currently. So if you see, there are some bagging of 175 crore order after that. Then they have signed more MOU with Andhra Pradesh government for some capacity expansion. This is again apart from the greenfield and brownfield capex that we have seen. Again, there was another major capacity expansion plan that came on November 20, I think. So keep on tracking this. These are good. Yeah, so coming to the last slide, some of the achievements they have done. These are the clientele. This is taken from investor PPT. I did not want to include investor PPT. I feel that you guys should go through it by yourself, and that should be good enough. But I wanted to give you overall what I understood from this sector and this business as a whole, and that's why I did not want to include from there. So they have done some like very good number. I don't know how they pulled it off, but within 150 hour they constructed 1.5 lakh square feet factory. This is like a record for them. They keep on bringing this in some interviews. You see ICRA rating, they have A plus and A1. These are the best in the market. They have 4 existing facilities. They have good presence overall, 14 location and all. These are yeah, mostly I am done, Puneet.
Yeah, great. I think you have taken it to the very, I would say, in a very nice way and compared with the Intertrack. We have the Intertrack presentation a few ALDs back from Bajaj.
Yeah.
I think it's a very good comparison as well. So they make everything in-house, whatever is required for
Yes.
this prefab.
Yes.
Okay. Okay.
So nothing is offloaded to any other company or anything. They make everything in-house. They have good team. Even the design approval, they do it inside. They have good softwares to. You can check some YouTube videos. They have shown that they do designing also, and many other things.
Yeah, sure.
Any questions from other players also? I have been tracking. So any questions from other players, I'm happy to take in this sector.
Yeah, thank you, Somnath. Rajesh here. This it's a great presentation, and I've been tracking both companies. So, and I've already invested. So, yes, it's a future sector as India is growing. So, definitely it will grow for next 5 years,
Yeah.
and we have to keep tracking every quarter. But definitely, one must have in the portfolio. One
Yeah.
question I have, on the EPAC, it is like Noida. They have a all factory, right? So, are they expanding something, in India, different places, or
Yes,
everything?
yes, yes. Andhra Pradesh, you saw right in my previous slide. They are doing
Okay.
so here with Andhra Pradesh government. There is a
Right.
Gujarat, so they are
Okay.
making different factories because see the movement of the goods for making this right. They should be near the factory or else it's problematic. That's why it is not easy to export. Uh, Pennar
Right.
and MBL has factories in US, but these guys don't have.
Which one? MBL.
Yeah, yeah.
Okay. Okay.
Pennar
Yes.
has, MBL does export. I think they do that, and they got a hit this quarter for the roofing business of there. That is
Okay.
why
Because
their
of
margins
what is
dipped.
good.
Yeah, so they did some inventory buildup in the roofing,
Mm-hmm.
and then the margins dipped. So it's tricky to export unless you have a factory there.
Right. Okay. So looks to me there the close players all are doing well, but
Yes.
definitely EPAC and Interac are maybe the leaders, the future leaders, and but definitely there's a very close competition to that, right?
Yeah, if you see in our schools, right, the
Hmm.
hunger the hunger for growth or the hunger for becoming first is more in the second second and the third player, right, in our school
Right.
and in our classes also, right. So EPAC has more hunger, and from their growth number it shows. um, the other players, Interact has been the leader, and we call him Mercedes of
Right. Their
E.
client base is very top level actually.
Yes, yes.
So
And they have
that's the thing.
EPAC has entered, I think, 2017-18, and Interac has been there for long. So still they were able to penetrate the market and grow at a better number than Interac.
Right.
That shows their ability. But
Okay.
yeah,
Yeah.
we have to track. We do not know these
Yeah.
past numbers. We cannot rely on, right? How they do after getting
Yeah.
listed is more important.
Right, for sure. But India is growing as we know, at least
Yeah.
for minimum 5 years, right? The growth will not stop.
Yeah.
So these will definitely grow as we have been doing a lot of construction, and we now like to speed up the process, and these things will speed up the process of building the constructions.
Yes. Yes.
Thank you. Amazing presentation.
Thank you.
Yeah, one question we have from Rishi. Rishi, you can go ahead.
Yeah, hi. Very well presented. Just quick thing on the margins fronts. Why is MNB able to sustain higher margins compared to any other competitors in the market? Is it because they are more of the export side of business, a bit of it, or what exactly is the reason? What do you think?
The MNB, MBL, whatever you call them. I have been tracking it, and I was invested till last quarter. And the reason for me not investing is I don't believe in their margins. So the margins may be sustainable, but we have to check because if you go through their con call and others, right, they have told that they can sustain this margin, but the numbers don't add up. They say that a export number is 4% of the total value, and then they say they are getting better margin because of export. Then the 4%, how does it add up? 4% of export cannot bring in such margin. They also tell sometimes that the roofing business has a better margin. That I agree with. That can be, but how much that can contribute, you have to calculate and see. So for me, MBL, their margins are better, but if you see current result, right, you will understand they could not sustain. They did not sustain, and that was a like bump for me, and I exited that
I
stock.
think that was because of the export business a bit or bit due to tariff and all sort of way because they had to take a bit of margin it because they had to realize
They
the
were,
bit of
I
export
think
expenses.
they were telling that export business has 24 to 27% margin. Even if tariff comes, you just calculate the number and see how much they should. They should do better than 12, 13%. But yeah, that's a question you have to calculate. I had a great discussion with many of my investing friends about
Okay.
the margins, and we could not come to a conclusion. So going forward, I'll keep tracking MBL margin for 3, 4 quarters and see what they told is what they deliver. Then I'll be happy. any excuse, right? You can give excuse after the numbers go down. But if you say that my margins will sustain, I want to see margins sustaining, not not giving every time one excuse or other. This time tariff, that time something else. That is not what I want to look.
Is it that you think that it's a bit cooked up in nature, the numbers?
No, that I won't say. That I can't say also. But if you do yourself calculation, right, we don't come to the margin that they're showing. So maybe due to confidentiality, they don't want to disclose the um, how they're getting the better margin. But better is to track and not believe what you see. If you see this quarter, it has dipped. So next quarter also, if say that it has dipped, if you see, then there is a problem. So that's why I am not very happy in investing in MBL. That is the sole reason. And you saw the
Okay.
stock price falling, right, after the
Yeah. It's nearly around
yeah.
390 something. Yeah.
Again, if you track Penner result, right, you will see that they have been talking about this labor issue 2 times now.
Mm.
Why are other companies not facing labor issue? Why are you facing? Why are you not fixing? These are questions you should ask, like we should ask, right? And if you
Yeah.
don't get proper answer, and the thing or the excuse keeps on repeating, then it is better to avoid. We have
Yeah.
full buffet, right? You can pick and choose.
Yeah. Makes sense.
Yeah.
Thanks for answering. Yeah.
Yeah. Thank you. Any other questions, Puneet?
No, I think no other questions for the time being. Thank you for your presentation.
Thank you, Puneet. Should I stop sharing?
Yeah, you can stop sharing and we'll move to the another presenter, Gopi Krishna sir.
Am I audible, Puneet ji?
Yes.
Can I share my screen?
Sure, go ahead.
Sorry. Is it coming to full screen?
Not yet. It's page.
What I need to do? I don't know. 1 second. Can somebody help me?
F5 if you can press on the screen. This keyboard F.
What?
Puneet, can I pitch in?
Yeah, please.
Okay. Gopi, towards the bottom of the screen, you see that sliding thing, no? Just left to it, there is a screen or sign kind of thing. Just click on that once, please. Towards the bottom on the screen, right hand side, there is a
This
slider.
one?
Left, little bit left. Come left.
Yeah, this icon. Don't go to the slider. Take the first icon to the left. Bit more left.
This one?
Yeah, that's the one. That's the one.
Press Shift 5 also will do.
So if you click on that, it will go to the full screen mode.
Wait, coming to.
Gopi sir, press Shift 5. Shift F5.
And it. I will share again 1 second. Is it coming now? Hello?
No. We are not able to see your screen yet. Maybe you have to click on that specific PPT.
Gopi sir, share the whole screen. There is an option, share PPT, share screen.
How is it coming?
Yes. Now you can press Shift and F5 on your keyboard. Shift, hold it, and press F5.
I've done it, but it is not going full.
Then you can click on that the icon you selected now, that one. Can you press it with your mouse?
1 second, 1 second. I'll take this control.
Yes.
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 Yeah.
Done.
Sorry. So not used to all these things. That's why. Yeah. Good morning to all. I myself is Gopi Krishnad, an individual investor. I first thank Punitji for giving me an opportunity. So I'm presenting a chemical company today. So this is my first online presentation. If there any fumbles or something, anything mistake like this, what happened, please cooperate with me. So as a disclaimer, I am not a SEBI registered. This content is purely based on my knowledge about the company and my thesis only. So don't take any decision based on these decisions, this presentation. So you need to dig deep, and if you are convinced, then only come into it, because I am already invested in this company. Next. Oh, there's not going to next slide.
You can just use the right arrow key and it will go on the keyboard.
It is not going.
Okay. Just click with the mouse on the screen, then anywhere, and it should still go. Try that. Yeah.
Yeah.
You went ahead to.
No, it is going up front.
Just use the left arrow key. Left and right arrow key works one screen at a time.
Yeah. Sorry for all this. So I just wanted to start saying that one thesis I learned from when I attended IAS Goa Summit, where Amit Jeswani of Stalin PMS has presented one beautiful study where he digged deep the data of the entire stock market of Indian stock market for the last 25 years. He identified nearly around 15 to 20 variant perception points, which actually re-rate any stock. So the data shows that the increasing in operating margins is a one parameter that actually gives gives more returns than any other parameter. That is a data backed story. So from that day onwards, I'm actually looking for the stocks which are actually there is any chance of increasing in the operating margins, because the market likes companies where they are operationally efficient. A 1,000 crore company doing a 2,000 crore company doing a 200 crores PAT will not be rewarded, whereas a 1,000 crores company doing a 120 crore PAT will be rewarded more by the market. That I observed for last 5 years. So the reason for choosing this chemical company is, you all know very well that in the chemical companies, commodity chemicals, how the margins have been suppressed and decreased due to China dumping. Surprisingly, in this company, for last 4 5 years, the margin is maintained stable, and now it has time has come for the increase in the margins. We will see. So this is what I am talking about for Vishnu Chemicals. The name already been seen by the people. So for last 5 6 years, if you see, in spite of so much of dumping by the China and all the major players, see, Vishnu is basically a commodity chemical company. All the players have been lost from the, say, Balaji Amines, for example, has doing a 28% to now to 14%. Deepak Nitrite from 28 to 14. Whereas if you see on the screen, this is 15, 17, 17, 16, 16. From 22 to now this one, they consistently maintain the margins, and the gross margins also in the range between 50 and 60 for last 8 years. In fact, even if you go the here also, for 8 years, they maintained above 45. So what exactly this company is, I want to see, I will want to explain, let us explore it. So as I said, the company I'm presenting today is Vishnu Chemicals, which was not discussed over just 1 week back because of the notification of acquiring mines. It has came to the limelight. Otherwise, nobody is talking about this one. So the playbook adopted by the Vishnu Chemicals for doing all these great things is just two things only. They are backward integration, forward integration, and import substitution. These are the three things which the management has consistently concentrated to get into in turbulent times, steady margins. Now it's the time to reap the benefits. I think so. Let us see. So briefly about the company, it is a Vishnu Chemicals is not a complex based chemistry or complex based type, that they are only into three products: chromium, barium, and strontium. Strontium is just plant has started 1 month back, though basically they are into chromium and barium only. So in this presentation, we don't go about the chemistry or something like that. I just want to highlight only the points which actually will aid the margins in this company, whether it's investment case or not. So as I said, it is in the chromium, barium, and strontium chemicals. And their risk profile has been somewhat, they have supported not to have any risk about concentrating on only few countries. They're slowly from 2016 to 25, in last 10 years, they expanded their export opportunity to around 50 countries and 10 end use applications. So we'll see next. So there is a brief history about the company. Company is in a Hyderabad headquartered company, started in 1990 by Mr. Krishnamurthy, and who is a first level entrepreneur who started this one in early 1990s as with a production of a whatever. See, chromium chemical means this is the main heart of the chemical, sodium dichromate, SDC. So they started with the production in 1990, and they acquired another chemistry called Keystone Industries in their competitor in Bilai at 1999, and they started a greenfield project with their own at 2008 in Vizag. So they went and bought a company from Solvay Group of Belgium. They entered into barium. So in fact, this is a story I will explain again why into the barium actually happened. They combined, they have in 2005, they sold it again, they bought back from Solvay Group and started into barium chemistry in Kalhasti plant. So they continued the barium and these two things up to 2025. Now they have entered into strontium chemicals also, the third one. And the third point is now these are the plants and capacities. So they got, as I said, Hyderabad in 1990, Bilai 1999, Vizag 2005, and Kalahasti 2016. The first three are into chromium. The last one is into barium, and the strontium also now is in Vizag in 2025. Now they acquired a plant in South Africa just 10 days back. Okay. These are the capacities also. Sodium dichromate is the main heart for these are the things, and chromium chemicals, and barium is the two parts are there. One is barium carbonate, and third one, another is 30 kilotons per capacity of barium sulfate, precipitated barium sulfate, PBS, which is actually growing like anything. And now they entered into strontium. So as I said, promoters are, the father is Krishnamurthy Garu, and the son is Siddharth, who was actually taken in the 2016, who actually completely transferred the journey of the Vishnu Chemicals, because 1990 to 2016 is the one part, and 2016 to 2025 is the second part. Now the third part of reaping the benefits will start now. So basically, briefly, we'll discuss about the chromium chemicals. So chromium chemicals is the main business vertical, which actually gives the 75% of revenues to them. Okay, and there are different products of chromium chemicals are sodium dichromate. As I said, it is the 80% heart of that chromium chemical. They are basic chrome sulfate, and they are chromic acid, chromic oxide, and potassium. We'll discuss about it briefly. So these are the different industries where this caters to. So refractory and tanning, food, paints, everything, paper, detergent, something like that. So as far as the position is concerned, they are the leading manufacturers of chromium and barium chemicals in India, and as well as even in the entire globe also. So they are in top 5 in the entire globe. It is very surprising to see one of the top 5 manufacturers are from Indian. So in chromium chemistry, there are 60% Indian market is dominated by Vishnu chemicals, whereas in barium it is 40%. It is growing very fast. And even in the world also, they are probably in 4th or 5th place in as far as both are concerned. In chromium especially, they are in the top 3, 4 or something like that. Only 1 or 2 big China players are there. One from Sisante, from actually something from South Africa, because the chromium mines are 70% is located in South Africa. So they are very good at they are number 1 in India and number 3, 4, something like that in the world. Okay, with this small background, we will explain the thesis, what is changing now. So please remember this slide. I will come back to this slide 3, 4 times to explain what is actually happening. As I had already told about the chromium chemical. There are 3 verticals. First, we are talking about the chromium chemicals. First one is the basic sodium dichromate. This is the one which actually started from 1990 to 2016. They 2016, even up to 2000, you can say, yeah, 16, 18. Sodium dichromate is the main basic one, which is a commodity chemical, which is used in some paints or something like that. The use case I already told you. So, but they don't have any pricing power here because it's a commodity chemical. So what they have done is, as I told, the playbook is go back to backward integration into forward integration. So they have actually in 2022, yeah, exactly, I remember now. In 2022, I will explain. So in 2022, this in order to have that sodium dichromate, two raw materials of chrome iron and sodium carbonate, that is nothing but soda ash. So to have that raw material procurement, they have done some R&D and they have done wonderful things. In 2022, they started a CO2 capturing plant, oxidation plant, where the flue gases which are released while the manufacturing of sodium dichromate has been reused to make the sodium carbonate. So this chrome ore plus sodium carbonate, which both will have around 75 to 80% requirement of the raw material. So to go, they have to go back to backward integration. What they have done is one of the beautiful ways that manufacturing of internal of sodium carbonate, which nearly constitutes about 40% of that raw material. Until unless that one, they are why they have in 2022 you have seen the margins are stabilizing, because the sodium carbonate they have done with that CO2 oxidation plant, with the starting of CO2 oxidation plant, they captured the flue gases released in the whole process and reused it to make the soda ash. With soda ash, which they use it to buy, which, Tata Power and so many companies will do, which fluctuates so much of volatility because of the China process. So that soda ash has been internally manufactured by them. Okay, that actually made them really for 8 rupees per kg savings for them because of that one. I will explain, come back to chrome core again. So the second part is, this one is the sodium carbonate. I think you people have understood why they have got that one. And then they went to some back and chrome ore. I already told you chrome ore and sodium carbonate forms 80% of the raw material. They have already covered in 2022 the sodium carbonate part, which has given them 8 rupees savings per kg. Then they went back, they wanted to have the chrome ore also. In the chrome ore part, entire in the world, 70 to 80% of the mines have been located in South Africa only. So South Africa, everybody wants to have the chrome ore from South Africa only. So recently what they have done is, and the wonderful thing is they acquired a chrome mine ore in South Africa. So this chrome mine ore is a shot in the arm. I will explain why. Because the market always respects the companies which have the supply side stability and power to withstand the volatility of the raw material prices. So earlier it is actually used to have 12 rupees per kg chrome ore prices. Now it has moved to 35 to 40 per kg. I already told you 70-80% of the entire world chrome has been in the South Africa. Everybody has started digging the South Africa. Now it is very difficult. It's not difficult. It is maybe the mining cost has become so costly that now it is becoming a 35 to 40 per kg. So the cost of is increased. So in that case, it is anticipated that the prices will not decrease, because once it is generally move up, because the mining they have to dig deeper. So acquisition of a chrome mine ore is a very good move according to them. So what are the benefits that they get for that one? So this chrome mine actually ore, what they have acquired, they have got at an area of around 1800 hectares with over 10 million tons of reserves. 10 million tons. Remember. So this 10 million tons after beneficiation, means that is cleaning or something, maybe at 5 million will be available for them for use of next at least 30 years. So for 30 years, they have actually secured, procured, and seized their raw material cost. Okay. So another thing is they have acquired for their capacity of 1 lakh. I will come back here and show you. For their capacity of sodium dichromate, which is at 80,000 metric ton capacity. Now it has been, they want to increase to 1 lakh metric ton capacity. So it actually, having a own mine will cost them hardly $1 per metric, $1 per kg or something like that. It will usually cost $3 to $5 if you buy from the miners. So straight away they have the benefit of cost advantage in the chrome ore and cost advantage in the sodium carbonate. Now they can make sodium carbonate with their own this one. So next for 40, 50 years, they have that secured of raw material thing. So MK Research has done some research report in, I think, in May 2025, saying that what are the benefits that may have that. So they have calculated that they will get for metric ton $250 will be the cost that they will do. It incur because of transportation and everything transporting from South Africa to here. But if the selling price is 300, what is the benefit of cost in the EBITDA level? And what is the selling price is 350, benefit of the cost in the EBITDA level that they will get. So if they translate into EPS, how much is the thing which is they will get. However, this is done in the May at the dollar rate of 86 rupees. Now it is at 89, and also the prices of chrome has decreased to around 270 something like that. Even though whatever the projections he have given is not valid, in fact, it is margin the spread is decreased to him. But the spread is decreased is not a negative for them because their cost at when the prices increases, no, they will get a huge humongous benefit, and their cost is almost all same because they are with their own mines. The advantage of this ore is they got they will it will take 2 quarters for them to start the mining. However, around 4 lakh tons of ore is readily available for them to use it. So readily available means they, even though there is, I am telling about 5 million tons are there, 5 million tons it will take for them to start the mining digging after 2 quarters. They will have a 4 lakh tons of ore which is readily available. So that can be used for another 1 to 2 years by the Vishnu chemicals for next Aram say. So then they will get, meanwhile they can mine the things, everything. The interesting part here is another part why they have actually acquired ore and another plant, beneficiation plant, and everything they have acquired, run of the mill beneficiation plant. Because of the acquisition of the plant itself is a huge advantage for them because the chrome ore which is digged in the South African mine is having a 22 to 28% of the chrome content, which is not actually usable. They need 40 to 42% of the chrome content. So since they have acquired the beneficiation plant there itself, they will actually do the beneficiation and they will increase the chrome content to 42 to 45% and they will transport it. Because they have actually done the beneficiation in South Africa itself, the freight tax will be added only on the value added of that difference between 42 and 28. That is also a huge advantage. I think you people are clear. I think they got the mine, they got ready reserves, they got the plant, they will do the beneficiation, and that beneficiation additional part only they have to raise a fight. Of course, the logistic ship cost that will be there for everyone. But these are the huge benefit they secured for 30 years and everything they have done it. So the above calculations also I have taken from MK Research only. For every $10 change in the chrome ore prices, about 250 will lead to 1 rupee CBS accreditation. Now it is hovering around 270 something like that. So if you that means if you give a 20 PE for a company, it a 20 rupees increase will be the price that you need to calculate that one. Okay. And definitely, since as I told you, the raw material from sodium carbonate and this one chrome, when the raw material price have been secured, you make 80% of your raw material in-house, then you will get a huge advantage for gross margins and EBITDA margins to take that one. Okay. The advantage also is it eliminates 2 layers of payment to distributors and mining companies, and this helps in the working capital light model. Actually, if you see the balance sheet of Vishnu Chemicals, you can see the working capital is very huge. They require a lot of amount for this working capital only. A calculation says that a reduction of 100 crore raw material maybe savings can be done from this acquisition by them. Okay, so as I already explained by the second part is the backward integration to manufacture soda ash, and and is not there, soda ash or sodium carbonate. So I said the carbon dioxide plant, which is actually done by them, is helpful to them. Okay. So now this left side part is over. They have entirely. Now I'm going to the right side part of this chemistry. So after securing the raw material from the left side, so producing the basic chemical, they decided that this basic chemical doesn't have the pricing power or something like that. So it completely depending upon the market. China is the dominating part, even though China doesn't dictate this one, but is there not a premium product or you can say specialty product? So China is having a lot of large chromium reserves, but there doesn't is not a competition to him. I will explain again. So they went into specialty chemicals now. So these are what are the specialty chemical products that they can make from this one. Why I'm telling is the sodium dichromate SDC, which is used to be 50% of the sales in 2016, and basium chromate sulfate is another 50%. They are used to have 100% sales in 2016. Now they have 30 to 32% is our specialty, only 68% from the basic chemicals. They increased in last 7-8 years. The sales of the specialty grade is like up to 32%. They want to take it to 50-50. And this sodium dichromate, where the prices doesn't have any power, any pricing power. So out of the 100 units produced by them, they are now actually consuming 66 units, one only for the internal manufacturing of specialty one. Only 33 they are actually selling. So raw material side they are run, the sodium dichromate 66% they are actually using for internal, and they are going into specialty. I will explain. So this is the forward integration to derivatives. Okay, as I said in 2017 SDC 50/50, now it is one they fell to 33/20. So this the sodium dichromate, which is actually I said as a vital one. It is at import price just 120 to 125 rupees per kg. They will take because because they are situated in Vizag and the plant is major plant is in Vizag. They will import everything and they will make the products here and they will again export here. So I actually work in Vizag, so I know about this company. That's why I'm telling you. So these prices are 120 to 125. So they went into the four products I showed in the diagram, four specialty chemical products. So one is the chromic acid, which is now contributing to around 70 to 80% of the revenues also. See the price of chrome acid, how much they are selling, 260 to 280 kg. There, 120 to 125 is the procurement price, 260 to 282 is the chromic acid selling price. See the other one, chromic oxide green, 350 to 370 per kg. See the chrome metal, 700 to 1200 per kg. Potassium dichromate, 250 to 300 per kg. So by procuring the raw material and making it, going into that one, at 125 they are procuring, they are making at 350, 300 and 370. The entire game will be changer will be the going into that chrome metal point. This chrome metal is used in superalloys as aerospace, turbines, oil and gas, nuclear and automotives. They are putting around 10,000 metric tons capacity for exclusively for chrome metal, which may come around Q2 of FY27. For that one, they have to increase this chrome oxide green because from chrome oxide green only further forward integration, the chrome metal will come. They are putting another 2 lines for the chrome oxide green, which will come into again in Q3 or something FY27 or Q2 FY27. So this chrome metal is actually an import substitute product. I told you the playbook is backward integration, forward integration, and import substitution. So import substitution chrome metal, India is around 2,000 metric tons annually they are using, which is 100% import substitute. Now they are going. It is the only company now it is going into the production of chrome metal. Then actually it is 2,000, but they are actually going for a 10,000 metric ton capacity because in export also huge demand is there for chrome metal also. So they are targeting the export, going into the forward integration, doing the backward integration, and which is actually the chrome metal is going to 10% in volumes, which all these things come in probably Q3 by FY27. If everything goes well, Q2, Q3 of FY27. Next slide is they are actually always trying to go into the new products, even though I have shown the four products in the slide, which I want you people to remember. But they are actually going into another new one called organic specialty solvent called dimethyl sulfoxide. They said that they are doing it for is a new. I don't know the details about it. They said that they are actually doing it one. They are raising the capital, borrowed money also. They are going into that product also. That will be ready by Q3 FY27. That is also a forward integrated product only. So 3 to 4 become 5. As I told you here, see in FY19, 24%, now 29, 30, 40, 36, 38. Now it is they want to make it 50-50 by next year and or maybe probably FY28 mid half the 50-50. So the specialty products, which the prices that I have shown that by 120, 125 they are buying, they are selling at 270,000 rupees, something like that. It will be a new speaker for the next. And I'll come to explain about the barium chemicals, which is the second vertical for them. 25% of revenue from coming from barium chemicals. But the same thing, this is the growth engine for them because it's growing at 25 to 35% per annum. These barium chemicals. So what happened is in 2005, the Solvay group of Belgium and Vishnu both have got some JV to have manufacture barium in Srikalahasti plant, but somehow they are unable to. Vishnu has sold this loss-making business to Solvay in 2005, and Solvay went ahead and had run the plant for 10 years, and Solvay realized that it is going to lose again. Vishnu by 2016, when actually Siddharth Dave, Vice MD, the son has taken over the second generation, they bought because in Solvay, Vishnu has actually worked for some time. So he had relations with marketing and international clients also. So when Solvay want to exit the business, again Vishnu bid for it and taken back the same plant of the Srikalahasti from them. and bought back and make it as a 100% subsidiary. So, and they turned it around, glass making business, and now it's into profit. And they started the exports with the links that Siddharth is having with other people in the already, because he's in the marketing side. And the exports now constitute 15 to 50% for FY25. It is growing at 35% per annum in volume terms. This is the barium actually chemicals revenue, the products, barium carbonate that used to be manufactured with when Solvay was the partner and when in 2016. But as explained the playbook, they went ahead and they've done the forward integration to precipitated barium sulfide. This precipitated barium sulfide is a filling agent which is actually growing at abnormal pace. For that 100%, that is an import substitute. Everything in India now has been imported. These people have entered into it, and it is used as in so many powder coating, automotive, the lucrative automotive paintings. So in paints, some titanium oxide TiO2 is something is there that has to be completely imported by India. This is the cheaper version, I think, hardly 10% per or something 50% of the price of titanium oxide as used by the precipitated barium sulfate, which is completely owned developed by the Vishnu. So the sodium sulfide, which is also another byproduct, which is used for the production of these two only, even though sodium sulfide is not a separate distance. Same thing as explained to you, what is the changing now? So byrate for barium chemicals, byrates is the raw material. So byrate, I told you already, because Srikalahasti is in Andhra Pradesh, where the nearby around 80 kilometers, Mangampeta mines are there, where the byrates, largest byrate is available in India is Mangampeta one is. Near the plant is hardly 80 kilometers from here. So where they procure everything. So they went, what exactly they have done is, they went to as usual to the backward integration. What is the backward integration? I will tell you. So they bought Ramdas Minerals, one company, which is very clear. This is taken from MK Research. This is where the plant is hardly 80 kilometers, 1.5 hour journey. But the byrates is, even though it is Mangapuram, I think Mangampeta in Kadapa district, which is around 80 kilometers. These byrates are as usual low grade byrates available. So this needs to be, what do you say? Benefication has to be done. It has to be increased to high purity, something like that. So low grade to high grade ore. So they bought Ramdas Minerals, and they are now doing all this verification within, and they are reaping the benefits like anything. Otherwise, they use it to get this high grade byrate ore from the other suppliers who actually bought and you are doing it. Because otherwise, buying it from byrate from mines doesn't have any benefit for them. So this actually improved the margins like anything, and even in the first quarter of year, they made at 30% EBITDA margins in this barium chemicals, because everything is internal only now. The playbook, the backward integration is the acquisition of Ramdas Minerals. So in original one is barium carbonate, and so barium carbonate is the leading exporter. As I said, 40% market share in India by this company, and 16 that one in chromium chemicals. So this also prices is increasing slowly from 22 to 40 to now 50, 60 kg. But the only thing is the China is the largest dominator here. China made soon the dumping. But still they are giving a run for their money for China because with their innovation, because of backward integration, forward integration, and they are cutting the cost. So forward integration in barium chemicals, as I told you, they went ahead and they manufactured one product called precipitated barium sulfate with a capacity of 30 kTA. So this is the growth engine for this one, as I explained to you. Titanium oxide, the third point you can see there, which in fact entered into this item of precipitated barium sulfate has got a Limca Book of Awards certification for that refractory ability of 98.1% of sunlight. So Guinness Book, I don't know, Limca or Guinness Book, I don't, some award has been given to this because they will give a 4 to 5 degree cooling effect. Okay. So in India, it approximately 18 to 20 K tons per year. If you observe carefully, they are having all the plants with a capacity in excess of what the Indian requirement is. So in every time India, if we have in chrome plate, in chrome metal, I explained you in chromium chemical, 2,000 tons is the requirement of India. They're going with 10,000. Here, India imports TiO2 at 18 to 20. They are having 30,000 metric tons of the capacity, so that export models are also they can gather into it. this is what I am telling you. So the precipitated barium sulfate with the the PBS it is called. See that imports of India. This is that every year this is actually going like this. The plant after this started full benefits became here. The completely imports have been reduced. That means this is captured by the Vishnu. They will actually going to capture more and more, I think. Okay, because it's growing like anything. These are used in, as you said, paint, pyramids, dyes, or something like that. Industrial chemicals also. As India grows, their demand for these things will be more. So this actually has a 100% import substitute. So this is the margin C, 34, 25, 36, something like that. They are getting. So I explained till 1 week back. I think they was starting of the strontium chemical in 2 months back, 3 months back. Even though they acquired some company, there are only two verticals which is contributing to the revenue. Even for the latest quarter results, also these are the two verticals. Now they went into the third one called strontium chemicals. It's a new vertical. This is also 100% import substitute. So strontium chemicals acquired in Vizag only, the JNC Pharma for 52 crores, Glasberg of so on. So further investment, they can do something around 120 crores. This strontium carbonate capacity is 5,000 tons in phase 1. The plant has a capacity to go up to 17,000 metric tons. They are going for 12,000 now, as of now, because 5,000 is the Indian requirement, 100% imported. Now they are actually catering to this one, and they want to make it to 12,000 metric ton. They want to increase it to 70,000 in a matter of 1 or 2 years. This strontium vertical, why they have done is strontium is Mexico people are the number one in the world. I think they are in one biggest competitor. They closed the plant for some problem. At this correct time, they are entering into strontium. So they can capture the market also there. Okay, that is the point. So why I am telling is a future growth driver will be. I actually taken the very conservative number of 150. The some estimates saying the 250. Even some reports saying that 600 to 700 crores at the full capacity of 70,000 metric tons only from this vertical. So everybody is because these are the second one, ceramic magnets. And the ceramic magnets is a small alternative to the rare earth metals, rare earth magnets. So there are rare earth magnets, everywhere they are used. China is dominating now. Government has announced a PLI, something like that. But you can say the replacement with a low cost one is called ferrite magnets. So in ferrite magnets, now the EV vehicles like Ola has got permission to use the ferrite magnets in place of permanent magnets from the government, Ola scooters. And TVS has applied for government to use ferrite magnets. So in the making of that ferrite magnets, this strontium chemical is used. So and this strontium chemical is used. This strontium is completely 5,000 tons imported. Now they are setting a plant for 10,000, 5,000 now phase 1, 10,000, and they will be the huge growth. I think it will be the huge growth driver for them. So you can see the pyrotronics, drilling fluids, glass, ceramics, and medical and dental. All the future growth industries will have this. So as I said, like that, very, very cost-effective alternative to rare earths. And the left side of the discussion, the commentary of the management report. We are working on another interesting backward integration project and also strontium carbonate. We are seeing a good demand, especially coming out. I see whether the backward integration happens in strontium or not, I don't know. Because strontium is not, the raw material of celestite is not available in India. Probably they have to buy from Mexico or something, Spain or something. Some 2 countries are there that are. So, as I said, the Mexico, one of the facilities which the 24,000 capacity has been out of the market suddenly. So, at the exact time they are entering into it. So, these are Vishnu's DNA. You can say they are import substitution, enhanced capex, backward integration, forward integration, everything they have done in chromium, barium, strontium. I am telling this chromium, this column for the chromium is completed with the acquisition of South African mine just 10 days back. It will take another two quarters to completely reap the benefits. So barium, the backward integration of the Ramdas minerals is completed and the effects have been seen from the first quarter where the margins went to even 30% now. So these two are completely. So this is the right time, maybe the inflection point, I feel, I may be wrong also, maybe the inflection point, and exactly at the same time entering into strontium carbonate where the new products are completely coming into picture. But when the 24,000 capacity of Mexico is out and 5,000 capacity of complete import substitute for India, and Ola got the permission from and TVS is getting the permission to use the alternative to rare earth magnets of ferrite. So without any risk, we cannot talk anything. So there are two risks for this. China, what is the effect of China and this one? China is, as I told you, chromium and barium both are in China is a very dominant market share. Even though chromium market is not a direct competitor, but it will determine the prices of the chrome ore. So even though in South Africa they will take the chemical grade chrome ore, but ferrite grade chrome ore prices, because it depends upon the stainless steel. Ferrite chrome ore is used in the making of stainless steel, for which China is a big giant. So they will decide the prices. So that is the competition. And however, I said they are run for money for this because of their cost optimization, backward integration, forward integration, which is actually visible for last 5 years if you see the margins. That's what I'm telling you. Why this I'm interested is because of the stability of the margins when everything went bad. That is the one. And the third important point is they export. They have deliberately taken export as a cushion for them because there is a huge demand there, and they are on par with China as far the products are concerned. And in Indian capacity, more than the Indian capacity, they have put the plants, and they alter the 45, 55, 50, 55, 55, 45, depending upon the rupee stability, depending on the prices where they're getting the margins, and that they play this game very well. So if you go on back to see the every quarter, say in Q1 the export import is 45.55, whereas Q2 is 49.51. I think probably Strontium has contributed. Strontium started not even started. I think depending upon the closure of the plants or something, they are playing that one. Okay, as far as tariffs is concerned, so total USA exposure is 7% on consolidated basis, because consolidated means 75 chromium, 25 is the barium. So, but in chromium only 5%, 12% is the barium. And interesting part is they doesn't have any tariffs on barium. So that means 12% of 25% share, it doesn't have any tariffs, whereas the chromium they have on the tariffs. And they clearly admitted that 50% tariff it is not sustainable for them. They cannot do anything because the local player, they're one local player in US, they're actually getting the market share. They're hoping for it to come back to 25 at least. If it stays at 30, like everybody is waiting for it for months together and days together, there is nothing coming out from the tariff. That is actually going to affect. But management is very frank enough to admit that on first order itself, see, strontium, there is no tariff. Barium, there is no tariff. Chromium, there is a tariff of 50%, but chromium is actually 75% for him. But what they said that even though we supply to 50 countries, second order effects of USA tariff may affect in future. That is the negative point here. The second order, these people will supply because this is not a B2C business, it is a B2B. These people will supply to the manufacturers in the other countries. So they ultimately make the products and they will supply to US. If US puts the, say for example, say they supply to, say for example, Denmark. If Denmark is having a 30% margin, if Denmark sales to US is reduced, they will have the second order effect. So that part is not clear to the management or anybody now. Everybody's I hope the tariff will come down and everybody will have the. So these are valuation metrics that done some thing for this one. So because there is a uncertainty regarding the sales happening because of tariffs and everything, on 2026 I have taken only growth of 10%. Because why 10%? Because they have done 9.9% in H1. So Q1, Q2 will be actually the more people are waiting to what happens to tariff. That's why in that area they have done 9.9% tariff. That's why I have taken only 10%, even though some stability may come if the tariff goes by December. Or otherwise also I have taken only 10%, that's one. And went back to 19% growth rate because after 2025, because by the time 2027 comes back, this growth, they will have that strontium Mexico product going out of market, and these have something, and respiratory is growing. I have taken 19% only, not assuming anything. And India also, because of all these cuts and everything, I expect India growth will come back. That is visible in Q3 numbers. I mean, GDP numbers recently also to 1919. If I done the math, maybe I have done something. I have not taken any benefit of interest cost because of reduction of 100 crores of working capital, because probably by the negative point in supplying, procuring chrome from board from South Africa here is earlier they have some 60 days of time to procure, give the money to the suppliers. Now, if they want to procure, they have to use their own money so that the working capital may become tight now immediately. Over a period of time, the cash may release and they will become disadvantage. So I have not done any interest reduction, and depreciation I have done, I increased it to 10%, 10%. Maybe some improvement, depreciation may increase by something, because I thought they have around 300 crores of capex, and the recent credit rating report, they said that they have taken a 400 crores for expanding another line. So maybe depreciation may increase. Even then, my conservative estimates comes as around by 2028 and 290 to 300 crores of PAT. So bull base case, why I have taken bull 25? Because base and bear. And I always tell to my friends and everybody saying that you need to take the last 5 years figures as the criteria, not the last 10 years, because the entire investing landscape changed with the last 5 years of coming of retail investors. So if you take the peak 5 years of 33 and 5 and 12 in the even worst case also, the first grade maybe it's a good consistent compounder with improvement margins, a doubler in 3 years is my analysis. That's why I have taken an interest one, but I am not guaranteeing it. Please do the things. So risk we will talk about raw material and mining risk. If delay happens in digging any mine issue or something like that, because yeah, the advantage this I will tell you, the $250 per metric ton calculation done by the MK Research for bringing 1 tons of metric ton of ore from South Africa here is considering the transportation is done on the roadways. Actually, the largest railway descent is there in South Africa. The railway wagon transport, they are in the mess. So I think South Africa's economy is not good. That one, something like that. If that improves and transportation done from the mining to port through trains, in fact, 250 will be the maximum. It will be it decreases. But some issues are there in South Africa. Local issues are there. In South Africa, the another thing is probably labor problem is also there. So that's why government said that in the mines, and the foreign entity should not have 100% stake. So that's why these people have 74 and 26 by the South African local government. And whereas in the plant, 100% is these people only. So execution risk on expansion, I said SDC capacity from 80, they wanted to make it to 20,000, and strontium capacity to 12,000 to 17,000. PBS is scaling up like very fast, growing at 30%. So that is there. And import pricing suddenly, for God's sake, if China goes into degrowth, everything will be gone out of the wind. So import pricing pressure on this. And I said that Indian, they are actually 50, 40, 45, depending upon the growth rates in India. Suppose if India goes, growth rate of India is reduced, then also there will be a problem for them. Technical analysis, as you've seen from them, is a weekly chart of they are consolidating between. I think in the ALD3, some investors has already presented this one. At time it went from 280 to 440 or something. Then again it is consolidating, and they are there for last I think 6 months. 480 something, 460, 470, 480 is the bottom, and 530, 544. If you go to the daily chart, actually, I think that gap filling is there around 520, 520 levels. It tried to break that one for 3 times, and it failed, and it went back to 480. And when the news came of Chrome ore acquisition, it actually crossed with a huge volumes. So with 520, it should act as a support for it, and it has to move up as per me. And as a member of ISOC tribe, I'm a ardent follower of Vishnu. I learned everything from Vishnu. So when by any selecting any stock, I will see the 10 points that Vishnu always says. The first point, past revenue growth is good in spite of so many headwinds. Also, there's good competitive intensity. Almost all they're monopoly in India and top 5 in the world. And consistency of margins, that is what exactly got me interested in this company. The operating leverage now going into new products, new geographies with Strontium coming into picture, I think it will pay. And cash flows, I think CFO to EBITDA it is 50 to 60% is not bad for a company, and that is also a tick mark. And market penetration in entire in India, in Strontium, they are import substitute, Barium, they are import substitute, completely 100% they are going in, suddenly closing of plants, they're going in. So market penetration is good. And volume growth, as you said, going into expansion, volume growth has happened 35% in Barium. That is the one. The eighth point is the only point where it fails. B2C will be greater than B2B and but sufficiently it's better than B2G. So it's also okay for me. And margin of safety, yes, I feel if you consider the valuation, margin of safety, I always think that whenever if without any change in the re-rating, based on the earnings, if it doubles in 3 years, I will go for it. That is a selection of my criteria, and I found it is definitely is one of the re-rating happens that the doubler will come in 1 year. That is a different story. But margin of safety is there. And stage analysis, it is in stage 2, yes, in stage 2, but in consolidation of the stage 2. So I feel everything has been tick marks 9 out of 10 ticket order. That's when I gone for it. Thank you very much for giving this opportunity.
Great one, Gopiji. I think you've covered in extensive details and why this is important to go from the basic to and then going to the specialty and backward integration on the mines and everything. Looks a great opportunity, I think, for next 3-4 years.
Thank you.
Yeah, any questions from participants? Yeah, I think Amar presented this to ALD back. Amar, you have any questions, thesis, counters?
No, I buy it this thesis. I'm still leveraging it up.
Okay.
So this is a trigger which I am also tracking. So after this presentation and the deep dive, it also kind of gives me more impetus that I'm on the right track. So I'll keep it pyramiding up.
Great. So yeah, any questions from participants before we break up for 10-15 minutes? No? Okay, fine. I think Gopi sir, you have answered all the questions in the presentation itself.
Right, sir.
Very
I'll
good.
appreciate them.
Yeah, please. Thanks for participating this time.
Thank you, sir.
Love your presentation. Okay, so I think let's stop for 10-15 minutes. Take a break and come back. 12:20 we should start back. So 12:05 it is there right now. So let's meet at 12:20 and you have to rejoin the same link again. I'm closing this meeting for the time. Thank you.